Picture the Forum Romanum in the late spring of 33 AD. The marble is warm under the midday sun, the smell of bread and dust rising from the side streets, and the great open square that is supposed to be the beating heart of the empire has gone quiet in a way that nobody alive has ever heard before. Creditors stand in clusters near the basilicas, demanding their money back. Debtors, men whose fathers and grandfathers had borrowed against farms and villas and shipping ventures for generations, are running through the colonnades trying to find buyers for land that, only weeks ago, had been the safest asset in the known world. And inside the imperial residence on the Palatine, an aging emperor named Tiberius is preparing to do something no Roman, no Greek, no Persian, no Egyptian ruler has ever done before in the recorded history of money. He is preparing to take 100 million sesterces of public funds and hand them, free of interest, to a handful of private banking houses with instructions to lend the money out into a market that has frozen solid. That intervention, in the consulship of Servius Sulpicius Galba and Lucius Cornelius Sulla Felix, is the moment most historians of finance now point to as the original sin of modern central banking. The first time a sovereign state stepped directly into a credit panic, opened its own vault, and pushed liquidity into private hands to stop a chain of failures from devouring the wider economy. The pattern we tend to associate with 2008, with the Troubled Asset Relief Program, with the emergency facilities of March 2023 after Silicon Valley Bank. That pattern is not a creation of the modern era. It is, if Tacitus is to be believed, a Tiberian one. 17 centuries before the Bank of England was chartered, almost 2,000 years before the Federal Reserve held its first meeting, an emperor in a toga did the thing every central banker since has learned to do under a different name. To understand how Rome arrived at that moment, you have to understand how Roman finance actually worked in the first decades of the Principate, because most popular accounts of the empire skip the ledgers entirely and go straight to the legions. The reality is that by the reign of Tiberius, Rome was no longer a city living on the loot of conquest alone. It was a city sitting at the center of a financial network that stretched from the Atlantic coast of Spain to the Euphrates, and the wealth flowing into the capital from the eastern provinces had been quietly transforming the way Romans lent, borrowed, and stored value for at least 2 generations. The publicani, the great companies of tax farmers and contractors who had once been the engine of Republican finance, were still active, though their role had narrowed under imperial supervision. Beneath them, and increasingly above them in raw scale, sat the senatorial banking class. These were not bankers in togas standing behind little marble counters. These were some of the wealthiest families in the empire, men whose names appear in the annals as consuls and praetors, who quietly ran lending operations through freedmen and agents in every major port. They lent to provincial governors who needed to outfit households. They lent to merchants outfitting voyages to India. They lent against vineyards in Campania and olive groves in Baetica and warehouses on the Tiber. And they lent to each other in a dense, overlapping web that nobody in Rome had ever bothered to map because nobody had ever needed to. Sitting alongside them were the great commercial houses of the Eastern Mediterranean. Modern retellings of 33 AD often name the firm of Sooths and Son in Alexandria, the Maximus brothers operating out of Tyre, and the Petty in Rome itself. The exact spelling of those names varies across centuries of transmission, and serious classicists will tell you the surviving sources are thinner than the confident retellings suggest. But the structure is real enough. The Roman credit system in the early 1st century was a circulatory network, blood moving through arteries that connected Alexandria to Antioch to Tyre to Ostia to Rome, and from Rome out again to Massilia and Gades and the trading posts of the German frontier. So long as the blood kept moving, Nobody examined the arteries too closely. What very few Romans appreciated as the year 33 opened was that the system had a structural fault built into it from the days of Julius Caesar himself. Decades earlier, in one of the financial reforms of the late Republic, a law had been passed, the Lex Julia, named for the dictator who sponsored it, that capped the legal rate of interest on most categories of loan. The cap had been controversial at the time, and over the years that followed it had quietly gone dormant. Lenders had drifted above the legal ceiling. Borrowers, desperate or ambitious, had agreed. Magistrates had looked the other way. By the reign of Tiberius, the cap was treated by most of the lending class as a historical curiosity, a relic, from an era when senators had still pretended to care what plebeian assemblies thought about money. What changed in 33 AD was that someone, in the Senate, decided to look at the curiosity again. The exact trigger is hazy. Tacitus, our principal source for the affair, tells us that prosecutions began under the old Caesarian law and that they spread quickly. Some accounts suggest a faction in the Senate had political motives, eager to bring down rivals whose wealth was built on questionable lending. Others suggest a more straightforward enforcement campaign, a moment in which the old statute was simply applied because it could be. Whatever the cause, the effect was immediate and catastrophic. Senatorial creditors, who had been quietly lending above the legal rate for years, woke up to discover that they were not merely embarrassed, they were liable. They faced confiscation of their estates, public disgrace, the unwinding of their entire financial position. Their response was the response of frightened men everywhere across history. They called in their loans. That is the sentence on which the whole episode turns, and it deserves a moment of attention, because it is the sentence that connects 33 AD to every credit panic that has happened since. A creditor calls in a loan. The debtor cannot repay in cash because the cash has been deployed into land, or ships, or grain stores, or further loans to other debtors. So the debtor must sell. He sells the vineyard, the warehouse, the slaves, the silver plate. He sells at any price he can get. And because every other debtor in the empire is doing the same thing in the same week, the price of land and goods does not merely soften, it collapses. The first defaults, contemporary accounts suggest, began in the East. Alexandria, the great commercial hinge between Rome and the Indian Ocean trade, was where the strain showed first. A major banking house there, the firm modern retellings call Sotheby's & Son, failed under the weight of obligations it could not roll. The news traveled west by ship and by rumor, the two fastest mediums of the ancient world, and by the time it reached the Italian peninsula, it had already triggered a similar collapse in Tyre, where the Maximus brothers, also named in modern retellings, were reportedly unable to meet their counterparties. By the time the panic reached Rome itself, the firm of the Petty, one of the more prominent banking names in the capital, was also reported to have gone under. If you want a modern parallel for what happened next, you do not have to reach very far. In September of 2008, after the failure of Lehman Brothers, the interbank lending market in New York and London simply stopped functioning. Banks that had been lending to each other overnight, every night for decades, suddenly refused to lend to anyone they could not personally vouch for. The price of money, in the form of short-term lending rates, spiked violently. Counterparties that had been considered safe in the morning were considered untouchable by the afternoon. The phrase that spread among traders was that everyone had stopped trusting everyone overnight. That is, in essence, what happened in the Roman credit system in 33 AD. The interlocking web of trust that had allowed senators to lend to merchants, to lend to provincial agents, to lend to local landowners simply ceased. Nobody knew which of their counterparties was solvent and which was about to be dragged down by the prosecutions, the forced sales, or the failure of some other House 3 jurisdictions away. So they did the rational individual thing, which is the catastrophic collective thing. They demanded everything back, immediately. Tacitus, in the 16th book of the Annals, gives us the line that has echoed through every history of money written since the Renaissance. A great scarcity of money ensued, he tells us, and the price of land fell to such an extent that the wealthiest were ruined alongside the most modest. It is worth pausing over that sentence. He is not describing a recession. He is not describing a slowdown. He is describing the disappearance of the medium of exchange itself from a city that, only months earlier, had been the financial capital of the known world. The wax tablets on which Roman bankers recorded promissory notes were piling up unredeemed on desks in the Subura and the Aventine. Coins had not vanished. They were sitting in private chests, hoarded by men who no longer trusted any bank, any borrower, or any future. The empire was suddenly cash poor in the middle of one of the wealthiest commercial systems the ancient world had ever produced. This is where Tiberius enters the story, and where the episode becomes something more than a Roman financial curiosity. The emperor at this point is in his mid-70s, has been on the throne for 19 years, and has spent much of the last decade in semi-retirement on the island of Capri. He is not popular. He is not warm. The historians who write about him from a distance of a generation paint a portrait of a suspicious, withdrawn, sometimes cruel man. But on the question of the financial panic of 33 AD, even his harshest later critics had to concede that he moved decisively and effectively. Suetonius, in his Life of Tiberius, records the intervention in compressed form. Cassius Dio adds detail. Tacitus gives us the most extended account. The figure is given as 100 million sesterces. Tiberius ordered that sum drawn from the public treasury, the fiscus, and deposited into a group of selected banking houses in Rome. The deposit came with conditions. The banks were to lend the money out for a period of 3 years. The interest rate on those loans was to be 0. The loans were to be secured by Italian land, valued at twice the principal of the loan itself. In other words, a debtor seeking to borrow from one of these state-backed houses had to pledge land worth 200 sesterces to receive 100 sesterces in cash, interest-free, repayable in 3 years. Read that structure carefully, because it is doing more work than it appears. First, the size. 100 million sesterces was a serious fraction of the annual imperial budget. This was not a token gesture. This was a deliberate sized intervention, calibrated to be large enough to move the market. Second, the channel. Tiberius did not hand the money directly to debtors. He deposited it with banks. This is the choice that makes the intervention recognizable to any modern central banker. The state is not picking individual winners. The state is providing the marginal lender, the institution that will step in and lend when no private lender will, and letting the banking houses themselves decide which borrowers are worth saving. Third, the rate. 0 interest. This is not a profit-seeking loan from the Treasury. This is liquidity provision in its purest form. The point is not to earn a return for the emperor. The point is to break the price spiral, to put a floor under land values by giving debtors a way to refinance without dumping their estates on a market that has no buyers. Fourth, the collateral. Land at double value. This is the part modern observers tend to skip past, but it is the part that protects the public purse. Tiberius is not handing out free money. He is lending against hard, productive assets at a conservative loan-to-value ratio. If the borrower defaults, the state recovers something real. The intervention is generous to the system, but disciplined toward the individual borrower. And the effect, by every account we have, was decisive. The freeze broke. Land prices stopped falling. The chain of failures stopped extending. The bankers who had survived the first wave were given the breathing room to work through their books in an orderly fashion rather than at the panicked pace the market had demanded the week before. Within months, contemporary accounts suggest normal lending began to resume. The web of credit that had been ruptured began, slowly, to knit itself back together. Rome, which had stood on the edge of a financial unraveling that could have shaken the political stability of the Principate itself, was pulled back from the edge by an emperor most Romans regarded with suspicion, and an intervention almost nobody at the time fully understood. What was buried in the aftermath was the lesson. Roman writers treated the episode as a one-off, an emergency measure by a single emperor in a particular crisis, not as the founding case study in the management of credit cycles. For most of the 17 centuries that followed, the technique was effectively forgotten. The collapse of the Western Empire took the institutional memory with it. Medieval and early modern rulers facing their own credit panics, the Medici failures, the Tulip Mania, the South Sea Bubble, generally responded with confiscation, repudiation, or executions, not with calibrated liquidity injections secured by collateral. It took until the founding of the Bank of England in 1694, and then the long, slow evolution of central banking through the 19th and 20th centuries for the technique Tiberius used in 33 AD to be rediscovered, refined, and dressed in the technical vocabulary we now associate with it. There is something humbling, if you sit with it for a moment, about realizing that the bailout was invented before the printing press, before double-entry bookkeeping, before the concept of a bank charter, before the modern corporation. An aging emperor on a Mediterranean island looked at a frozen credit market, did the arithmetic in his head with the help of a few advisors whose names mostly have not survived, and reached for the same lever every finance minister and central bank governor of the modern era has reached for since. The lever was there all along. We just lost the manual. Bring all of this forward to 2025 and the pattern begins to look uncomfortably familiar. In October of 2008, the United States Treasury, faced with a credit market that had gone into something very close to the Roman freeze, created the Troubled Asset Relief Program. The structure was different, the legal instruments were different, the scale was vastly larger, the political controversy was loud, where Tiberius's intervention had been mostly silent, but the underlying logic was identical. The state deposited capital into selected banking institutions to thaw a frozen market and restore the flow of credit. The collateral arrangements were more complex. The terms were negotiated under enormous time pressure. But strip away the modern vocabulary, and what you are looking at is a Tiberian intervention with a different name. In March of 2020, as the pandemic shock seized credit markets, the Federal Reserve launched a cascade of emergency lending facilities, commercial paper funding, primary dealer credit, money market mutual fund liquidity. Different mechanisms, same purpose. Provide the marginal lender when private lenders have stepped back. Break the price spiral before it consumes the system. In March of 2023, after the failure of Silicon Valley Bank, the Federal Reserve created the Bank Term Funding Program, lending against government securities at par value rather than market value, to give regional banks a way to meet deposit outflows without crystallizing losses on their bond portfolios. Again, different technical structure. Again, the same Tiberian logic. State liquidity, posted against collateral, deployed to halt a chain reaction that the private market could not arrest on its own. None of this is offered here as an endorsement or a criticism of any particular modern policy. Reasonable people disagree, often passionately, about whether these interventions create moral hazard, whether they socialize losses while privatizing gains, whether they distort the price signals that healthy markets depend on. Those are real and important debates, and they belong to the present, not to a Roman history script. The point worth holding on to. The point this entire episode of the Empire Ledger Historian comes back to is structural rather than ideological. Credit systems, left to themselves, periodically freeze. When they freeze, someone with the authority to provide liquidity will be asked to provide it. The form of that someone has changed across the centuries: emperor, monarch, central bank, treasury. But the question they face has not. How much? To whom? Against what collateral? At what price? Tiberius answered those questions in 33 AD with a precision that would not look out of place in a modern term sheet. 100 million sesterces to selected houses against Italian land at twice the loan value, at 0 interest for 3 years. Every credit cycle since has produced its own variation on that template, and every credit cycle ahead will produce another. So as we sit in 2025, watching the ongoing aftermath of the regional banking strains of 2023, watching the slow unwind of pandemic-era liquidity, watching the structural questions about commercial real estate and private credit that financial commentators argue about every week, the Tiberian question is the one worth keeping in mind. Not whether there will be another moment when a credit market freezes. History suggests there always is, eventually. The question is, which institution will be holding the deposit when it happens? On what terms? Against what collateral? And at what price to the broader system? That is a question this channel cannot answer in advance. Nobody can. But the next time you hear a central banker on a podium describe an emergency facility in careful, technical language, remember the marble of the Forum Romanum in the late spring of 33 AD. Remember the wax tablets piling up unredeemed on a banker's desk. Remember the consuls Galba and Sulla Felix presiding over a city that had forgotten its own usury law. Remember an emperor most Romans disliked doing the right thing for reasons most Romans did not understand. And remember that the playbook being read from in 2025 was due, in its essential outline, written almost 2,000 years ago. In the next entry of the Empire Ledger Historian, we will turn from the Tiberian intervention to the Roman debasement cycles that followed in the centuries after. The slow, grinding inflation that ate the silver out of the denarius and helped set the stage for the political crises of the 3rd century. If the Panic of 33 AD is the story of a state stepping in to save a credit market, the debasements that came later are the story of a state quietly extracting value from its own currency to fund itself. Two sides of the same Roman coin in the most literal sense. We will see you there.